In this presentation, we will continue on with our adjusting entries for our comprehensive problem, now working with unearned income. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So we got unearned income, unearned revenue. So I'm going to scroll back. We're going to try to figure out which two accounts will be affected by just knowing that we're dealing with unearned income, unearned revenue. A little bit more difficult, but the same principles apply. We're going to have, because it's an adjusting entry, one balance sheet account, an account above the blue line, an asset or liability account, and one below the equity section, a revenue or expense account. Looking at the balance sheet accounts, we see that we've got the assets and liabilities. We're dealing with something that's for unearned revenue or unearned fees or unearned income. If we have the trial balance there, we'll look through that and we'll see, unearned fees or unearned revenue. We won't know exactly what that is possibly, but we could say, it's got the same term in it. So I'm going to say that's probably one of the accounts we're going to deal with. And then we're going to say there's going to be some income statement account related to unearned fees or unearned revenue or unearned income. And there's nothing that says unearned on the income statement, but there is revenue or income. The other side is revenue or income. So I'm going to say that I'm going to highlight this one and say that's the other side of it. Now that revenue, that might have been a little bit tricky. This one dealing with income is a little bit different than some of the others we've seen because clearly there are more expense accounts on the income statement than revenue accounts. So we're probably when doing these adjustments, we're probably most used to adjusting expense accounts. But of course, there are a couple adjustments to revenue, this being one of them. So before we get into what we're doing and why, we know that the income statement accounts always go up, and this is revenue having a credit balance. So it too only goes up. However, it has a credit as opposed to the expenses which have debits. To make it go up, we do the same thing to it, which in this case is a credit. So we're going to copy this. We're going to put that on the bottom. So here's our date. We're going to be on the bottom of it in C18. Right click and paste. 1, 2, 3. Going to go ahead and format that with a little indentation. Go into the Home tab, Alignment, and increase that indentation. If this is the credit and this is the other account affected, it must be the debit. So we're going to copy the unearned fees, right click and copy, put that on top in the cell of C17. Right click and paste 1, 2, 3. So there's going to be, we know what we're going to do without knowing why. Now let's see why, which we'll need in order to calculate the number. So it says that unearned income is 1,000. So what does that mean? Before we even get into that, let's tell a little story about what an unearned income is. How did this 3,000 get on the books? It got on the books because someone paid us money. We got money from a customer. And normally when we get money from a customer, for most businesses, it's because we did revenue. So the journal entry would be debit, cash, and credit revenue. Or it's because we got paid for something we did in the past, meaning debit, cash, and credit the IOU because we invoice the client, we're getting paid. In some types of industries or in some situations, we actually get money before we do anything. And in those types of industries like a magazine, newspapers, subscription-based things, then we have to debit cash, but we can't credit revenue when we got paid because we haven't yet earned it. We credit instead unearned revenue. This then represents a liability, something we owe. However, not money we owe. We owe service. We owe whatever we do. We owe work. If we don't do the work, then we should pay the money back. But we owe, in theory, services. So notice this is $3,000 worth of our work. Okay, so now we're going to say that some of that has been done. We did some work and therefore are going to be reducing this $3,000 for the work done. So therefore we have to determine, like if we do a service company or if we do a subscription-based company, we'd have unearned revenue every time we get paid. We'd be increasing cash and increasing unearned revenue. Then we'd have to go through all that unearned revenue and figure out how much of that has actually been earned. How much of the subscription service have we actually provided to customers? Because that will determine how much of it should be recorded as revenue. Typically in book problems, they're going to tell us this way. They're going to say unearned revenue should be this number. They could also phrase it as, of the unearned revenue, this is how much was earned. notice there's two differences there. I mean, I could tell you what, in other words, what is still unearned as of the financial statement date 3/30/1/31, or we could tell you how much has been earned as of this date. Usually we try to figure out how much is still unearned, and then we have to do a subtraction problem to get this number to it. So in other words, the problem is saying unearned income on May 31st is 1,000. That's what still hasn't been earned. That's what work we still have to do. How much has been earned then? Well, if there was 3,000 unearned and before this, and we only have 1,000 left, the subtraction, 3,000 minus the 1, gives us the 2,000, which has been earned. So the math then would be in cell D17 equals 3,000 minus 1,000. That's what it should be to get us to 2,000. That, of course, will be the debit and the credit. And then if we post this, we'll get to get and see if it does what we want it to do. What do we want it to do? Again, this unearned fees, unearned revenue, unearned fees, unearned income should go from 3,000 down to what we determined it should be given our calculation for this adjusting entry to 1,000. And then the revenue is going to go up because we're recording the fact that we've earned it now throughout this time period, and therefore should be recognizing it in accordance with the revenue recognition principle. Okay, so let's do that. Here's unearned fees. Here it is on the trial balance. We're going to be in the middle column in I-14 where we say equals. Point to that 2,000, bringing that 3,000 balance down by 2,000 to 1,000. Then we're going to go to revenue. We are in cell I-19 where we say equals. Point to that 2,000, bringing that 27,000 up by 2,000 to 29,000. What's the effect of this journal entry? It brings the liability down and it puts net income up. So this is one of the journal entries we kind of like to record because it actually increases net income. It's one of those that we don't often see with many industries because a lot of industries will not have unearned fees or unearned revenue because they have to do work before they get paid or at the same time of payment. But it's one of those that will increase the income or revenue, which is nice. So net income went up, or I'm sorry, net income did go up, but revenue or income went up, which brought net income up in this case. And that, of course, brings up total equity as well. For more accounting information and accounting courses, visit our website at accountinginstruction.info.